Okay, let's just jump right in. There's this massive misconception floating around about who actually has to pay taxes in India. And today we're going to bust that myth wide open. We're going to get down to the one single thing that determines your tax bill. And here's a little spoiler for you, it has pretty much nothing to do with the passport in your pocket.
So let me ask you this, and I'm talking to everyone watching, right? Especially if you've got ties to India, but you're living somewhere else, or maybe you're a foreign national working in India. Do you pay Indian income tax? The answer, well, it's probably not as simple as you think. All right, first things first, let's get this straight. Your citizenship, it is not the deciding factor. I mean, you could be an Indian citizen living in, say, Canada and owe zero tax to India. Or you could be a Canadian citizen living in Mumbai and be on the hook for the whole thing. So if it's not about your passport, then what on earth is it about?
It turns out the entire system, the whole basis for how your income gets taxed in India, it all boils down to just one single crucial thing. This is the bedrock of the entire Indian tax code.
And that one thing? It's time. Yep, that's it. It's literally about counting the number of days you are physically inside the country during a financial year. Where you are, your physical presence, that's what the tax department really cares about. And hey, don't just take my word for it. This isn't some clever interpretation, it's the official rule, straight from the horse's mouth. This quote right here from the Income Tax Department says it all. They make it crystal clear. It's not about your citizenship, it's about your residential status. And guess what determines that status? You got it, counting days. Okay, so how does this day counting business actually work? Let's dive into the nitty-gritty of figuring out your residential status. All right, I want you to burn this number into your brain. 182. 182. This is the magic number, the most important threshold in all of Indian tax law. Honestly, the first test couldn't be simpler. If you are physically in India for 182 days or more in a single financial year, that's from April 1st to March 31st, boom, you are automatically a resident for tax purposes. No ifs, ands, or buts. End of story. But what if you stay for, say, 181 days or less? Well, you're not automatically off the hook. This is where things get a little more complicated. Okay, take a look at the official flowchart here. So, you didn't hit the 182-day mark. Now we move to the next test. And the question is twofold. First, were you in India for at least 60 days this year? And second, have you been in India for a total of 365 days over the last 4 years? If the answer is yes to both of those, well, you could still be considered a resident. It's kind of like a backup rule, the second big test you have to pass. So, you've done all this math, you've counted all your days, and you figured out if you're a resident or a non-resident. But so what? Why does this label matter so much? Well, because it's everything. It determines exactly what income India can tax and what it can't. And to be super precise, the Income Tax Act actually breaks it down into 3 different profiles. You've got resident and ordinary resident, or OR for short. Think of these as people with really deep roots in the country. Then there's resident but not ordinary resident, or RNOR. These are folks who are residents but maybe a bit more transient. And finally, you have your non-resident, or NR. And trust me, the tax rules for each of these are wildly different. This table here, it lays it all out perfectly. Check out the first 2 rows. See how they all say yes? That's because any income you physically receive in India or that comes from India is taxable for everybody. Doesn't matter what your status is. But now, look at that very last row, foreign source income. That is where the game completely changes. So here's the bottom line, the most important takeaway. If you are a resident and ordinarily resident, India taxes you on your global income. Everything. That salary you earned in New York? Taxable in India. The rent from your flat in London? Yep, taxable in India too. But if you're a non-resident or an RNOR, you're pretty much only taxed on your Indian income. And that, my friends, is a huge difference. Okay, to really see why this matters, let's get practical. Let's walk through a super common situation where your status can mean a massive difference in your bank account, capital gains from selling an asset. So first off, what even is a capital asset? Think of it as basically any big-ticket property you own. We're talking real estate, stocks, bonds. Now, your everyday personal stuff like your clothes or your couch, that's not included. But valuable things like jewelry, art, that kind of stuff? Yep, those count as capital assets.
Now, this is important. The way you calculate your profit for tax purposes has changed. Look at the left side. That's the old way. You used to get this really nice benefit called indexation, where you could adjust your original cost for inflation. That meant your taxable profit was smaller. But now, look at the right. Under the new rules, that benefit is gone. It's just sale price minus original cost. And as you can see from the numbers, that usually means a much bigger taxable profit.
And just when you think you've got it figured out, things are about to change again. The rules are getting tighter, so you're definitely going to want to pay attention to what's coming next.
Okay, get your calendars out. April 1st, 2026. That's the date. It's when some pretty big changes to these residency rules are going to kick in. And these new rules, they're aimed squarely at a specific group: high-income NRIs and PIOs, folks who have significant financial connections back to India. So there are two massive changes on the way. The first one is a new day count. For people with Indian income over 15 lakh rupees, that magic number to become a resident but not ordinarily resident drops from 182 all the way down to just 120 days. But the second change? This one is a real game changer. It's a new deemed residency rule. Basically, it says if you're an Indian citizen, you're earning a good chunk of money from India, and you're not paying tax on it anywhere else in the world, like if you live in a zero-tax country like the UAE, then India will just deem you a tax resident. And get this can happen even if you don't spend a single day in India all year. Wild, right? And you might be asking, why are they doing this? Well, the logic is actually pretty straightforward. This quote from the experts at Ushman Associates nails it. The whole point is to close a loophole. They're trying to stop a situation where someone could earn a lot of money from India, live in a tax haven, and end up paying zero tax to any country. And all of this brings us to one last big thought-provoking question, right? This whole system we've just walked through, it's all built around one old school idea: physical presence. It's about counting days, about where your body happens to be. But now we live in a world of remote work, of digital nomads, where you can make a living from literally anywhere on the planet. So you have to wonder, is a tax system based on physical location really built to last? It's definitely something to think about.